Thank you. As Craig mentioned, I work for an investment management company out of Boston, Massachusetts called MFS. And one of our primary jobs is to work with our portfolio managers and analysts from our firm and streamline that information to financial advisors across the country, like the ICG Next team that you all work with. But the second part of my job, and I'd argue the best part, is I get to partner with financial advisors to provide education on advanced planning topics such as Social Security, which is why we're all here this afternoon. So, I think there's so much confusion surrounding Social Security, and gaining knowledge on this topic will be incredibly important, because what we've seen as investors is that the educated client, the educated investor, are by and large the most successful ones in the industry. So my goal over the next 25 to 30 minutes or so is to make everyone just feel more comfortable and confident when it comes to your Social Security election. So without further ado, let's jump on it. So there we go. Many of us have either received a Social Security statement in the mail, or maybe we've signed on to SSA.gov and created a My Social Security account. And, I think what the tendency is, and what most folks look at first, is that number, right? What is the amount of money we're going to receive from Social Security at full retirement age? Now, FRA, or full retirement age, technically is known as your primary insurance amount, or PIA. Clearly, Social Security loves to use acronyms, but what I'd say other parts of that statement we look at is the table of our earnings that goes back to our very first job. Now, those are important, but what I think is really where our attention needs to focus is actually on the second page, which is where what we've highlighted here in blue on the right. And what it says is that Social Security is not intended to be your only source of income in retirement. Now, on average, Social Security is supposed to replace about 40% of your annual pre-retirement earnings. So the point is, you will need other savings, other investments, other things of that nature to live comfortably throughout retirement. So if you take one piece of information away from today, my hope is that maximizing Social Security is one piece of that puzzle, but it's important to be working with a great financial advisor like the group at ICG Next to make sure that you have that full comprehensive financial plan to take care of the other 60% of that retirement income. Okay. And that 60%, it's going to look different for every single one of us. We might have a pension from a current employer or a former. Maybe it's a 401k, a 403b, an IRA. Some of us might want to continue to keep working, or some of us might have rental property that's going to provide additional income. The point is, all of these different sources or puzzle pieces factor into that retirement income picture. So the goal for today is to take a closer look at that Social Security piece of this puzzle. So as we mentioned before, what we're going to look at is a discussion on how Social Security retirement benefits are calculated. And when I say retirement benefit, I just mean personal Social Security. We'll move on and talk about options for our married couples. And then we'll close it out with information around most people's favorite topic, the role of taxes and your retirement plan. So let's jump in, start talking about how Social Security retirement benefits are calculated. The Social Security Administration, they use something called full retirement age, or FRA, as the basis for calculating any Social Security benefit. So take a look at the chart and identify what your FRA is. Now, it starts at age 66 if you're born between 1943 to 1954, and then it'll gradually increase up until 1960, where full retirement age will be 67 years old. So if you're turning 62 this year, your FRA is going to be 67. So again, it's important to identify what your FRA is, yes, for this presentation, but it's really going to make a lot of your claiming strategies with Social Security easier to understand. And what we're going to take a look at right now is, if you claim a Social Security benefit before that full retirement age, benefits are permanently reduced. If you apply for a benefit after full retirement age, they grow or are maximized. So let's jump in. How do we qualify for Social Security? Well, you're eligible for a retirement benefit after you've worked for 40 quarters, or you've paid into Social Security for 40 quarters. That is about 10 years of earned income. Good thing is it doesn't have to be consecutive, it can be in and out of that workforce. But once you qualify, how do you get that number that you see on that statement? What the administration does is they average your 35 highest earning years of work to determine what that benefit amount will be. Once again, it doesn't have to be the 35 most recent. A lot of times it tends to work that way as folks make more money later on in their career. But if you were killing it with your first job and that was one of your highest earning years, that will count towards your benefit amount. So we have that amount we see on the statement, right? That's telling us at full retirement age. But as we said earlier, and what you see with these graphs is if you claim prior to full retirement age, you receive a permanent reduction in your benefits. So if we look at the right-hand side, age 67 in green, we claim as early as we can at 62, we see a 30% reduction. However, if we wait and maximize or allow that benefit to grow past full retirement age, we have a guaranteed 8% growth each year up until the age of 70. Now that growth, or that 24% over those remaining years up until 70, is in addition to any cost of living adjustments that the administration issues each year, which typically come out at the end of October. So we will know 2025's cost of living adjustment, or COLA, as we approach the end of next month. And that will be applied to your benefit whether you're claiming it or not. Now, the average American in 2023 actually claims Social Security benefits as early as they can at age 62. And while, yes, you're going to permanently reduce that benefit, there's something else you want to be aware of as well. And it's what Social Security calls their earnings test, or earnings limit. And it's kind of a double whammy, right? You're getting a reduction in your benefit because you apply early, but then you get a withholding penalty because you're still earning money from your job. So Social Security wants it to be an income stream, not a bonus check. They withhold some of that benefit. So take a look at the two boxes that are grayed out. If you're younger than full retirement age in 2024, the SSA will withhold $1 in your benefits for every $2 that you earn over $22,320. Now, once we reach the full retirement age, so if I'm turning 67 in December of this year, or next year, right? My 67th birthday is November of 2025. Starting in January of that year, they give you a little bit more leeway. They'll deduct $1 in those benefits for every 3 that you earn over $59,520, up until the month you reach full retirement age. So if my birthday was on the 14th of November, they would look at that until November 1st. Now, this withholding will apply to any Social Security benefit. So that's personal retirement, it's a spousal benefit, it's a survivor benefit, and a divorce benefit, all the same. Now, for our married couples, this question comes up quite a bit. The earned income is only being looked at by the individual that is collecting Social Security before full retirement age. It is not a combination of both spouses. So just be aware of your what you're earning if you're ready to claim. Now, with this earnings limit, what truly determines earnings? It's wages. Okay, so any unearned income, so think about those pensions, those IRAs, the rental income, those are not going to cause Social Security benefits to be withheld if you're working and under full retirement age. So those are a couple of the basics when it comes to the personal retirement benefit. I do want to segue now into the options that are available for anyone who's ever been married. So we're going to talk about what is called the spousal benefit. And a spousal benefit is available to anyone, even if you have never worked a day in your life or you've never paid into Social Security, you can still receive up to 50% of your spouse's benefit at full retirement age. Now, they are available as early as age 62. So if we claim at 62, like we saw earlier, we are going to receive a spousal benefit, but it's going to be done at a reduced amount of 32.5% to 35%, depending on your FRA. And that 32.5% to 35% is based off your spouse's full retirement age number. Now, in order to receive that spousal benefit, your husband or your wife, they must have applied for their own Social Security benefit. And a couple other things. Only one spouse at a time can receive a spousal benefit. So if you've both worked, you've both paid 40 quarters into Social Security, what the administration will do is say, we're going to give you the benefit of the doubt, the greater of the two. So if it's your own or your spouse's, you're going to get that higher amount. The other thing is for spousal benefits, they're always based on your spouse's full retirement age amount. So it doesn't matter if they claimed at 62, if they claimed at 70, if their full retirement age is 67, that is the amount that we're going to base our spousal benefit off of. So I really want you guys to notice that, right? That spousal benefit does not continue to grow past full retirement age, even though the retirement, personal retirement, or a survivor benefit that we'll talk about will continue to. For spouses, while both are alive, it's always going to be capped at that full retirement age number for your spouse. For our divorced couples, it's going to be calculated the same way. We are going to discuss this later on in the section, but just so you know, that is kind of the same ideas of what we're going to be looking at. But before we do move on, I just wanted to share a quick example on the spousal benefits, just to go a little bit deeper. And we put together a case study here of Jack and Diane. So if we have any John Mellencamp fans out there, this is where we picked them out. But we're going to assume that both Jack and Diane have a FRA of 67 years old. So Diane was the career higher earner. Jack's personal retirement benefit is less than what he could receive off of Diane. And then we look at Diane's amounts. At 62, she can receive $7,000. At her full retirement age, $10,000, and at age 70, $12,400. So Jack, again, as that lower earner, wants to know what's the minimum and the maximum he could receive from his spouse, Diane. And that's what we look at here. Okay, on the left-hand side, we just put the numbers that we just looked at into a chart, right, at 62, 67, and 70 for Diane. But if Jack claims as early as he can at age 62, he receives a reduced spousal benefit of 32.5% off of Diane's age 67 number. So he receives $3,250. Now, if Jack claims a spousal benefit when he is full retirement age, so Jack is 67, he gets the full spousal benefit, the maximum amount of 50%, or $5,000 off of Diane's age 67 amount. Again, if Diane claims at 62 or 70, that won't change. We're always looking at her age 67, $10,000 number. Now, obviously with spousal benefits, it's not always going to be this clean where, you can receive that benefit once your spouse does. And a lot of times this does come up. We were actually, chatting about this earlier. What happens if you're ready to claim before your spouse is? You don't switch benefits. What happens is what we look at here. It's called the excess spousal benefit. So essentially, you're initially going to receive your own reduced retirement benefit when you apply. And then when your spouse does claim Social Security, the administration tops off your existing benefit amount with that excess spousal benefit, which is the calculation that we see here at the bottom of the screen. So the max spousal benefit at full retirement age. So half of our spouses, if we think back to Jack and Diane, $5,000 would go in the middle. And then we subtract out our full retirement benefit amount. So Jack's was $1,000. That difference is added on to the amount that you're already currently receiving. So if you're married and you're ready to claim and your spouse isn't, keep this slide in mind. And hopefully this will help you figure out what those benefit amounts will be and know that you'll have the ability to increase some of that in the future if you are that lower earner. And I think this is probably one of the most applicable real life scenarios that we do look at. So just wanted to make sure we highlight this for everyone. But we've looked at our options now when both spouses are alive. I do want to move on to, unfortunately, what happens when one of those two spouses does pass away. So similar to our spousal benefit, Social Security, they offer a survivor benefit. And after that higher earner passes away, the administration provides a benefit to that spouse in the amount of the survivor's benefit, or basically what the survivor was receiving depends on when that higher earner or the deceased claimed their own benefit. So the higher that the deceased benefit was, the higher that living spouse's survivor benefit will be. Now, you can claim a survivor benefit as early as age 60, which again is at a reduced amount, which is 71.5% of the deceased's benefit. But that surviving spouse could receive 100% of what the deceased had been claiming if the living spouse is full retirement age or older when they claim the survivor benefit. So again, even if that surviving spouse had claimed a reduced personal benefit or a reduced spousal benefit, they can still get 100% of that deceased benefit if they're full retirement age or older when they apply. Let me take a look at that last point one more time. Okay, if our living spouse is full retirement age or older and they claim a survivor's benefit, they receive 100% of what the deceased was receiving at death. Now, that surviving spouse, again, is an amount that equals the higher of their own or what the deceased had been receiving. So in our example here, our lower earner claimed their own personal retirement benefit at 65, received $1,042. Now, the higher earner passes away 10 years later, and now our lower earner is 75, so over full retirement age. Because our lower earner is well past FRA, and that is when they claim the survivor benefit, they step up to what the deceased was receiving at the time of death, which is the $3,125. Okay, so that claiming decision of that higher earner can be very impactful, not just for yourself, but for that survivor benefit. And just to really highlight what that looks like, I wanted to take a look at what the average Social Security retiree received last year in Social Security benefits that they claimed at full retirement age. So that's the number that we see right in the middle in blue, $27,500. Now, I want to bring your attention to our green bars now. The difference in the survivor benefit for the higher earning spouse, or our green bars, if that higher earner claimed at 62 versus age 70, is a difference of over $20,000. So as a higher earner, I want you to ask yourself, could an extra $20,000 a year make a difference to your spouse once you pass away? And for that spouse that has that higher benefit, it's hard, but try to change that conversation from me, I paid into Social Security, I want it now, to what is best for our family unit, for my spouse, for my beneficiaries, because the spouse that has that higher Social Security benefit, it will become the benefit of your surviving spouse once you pass away. So those are our options that we're looking at for our married couples. The next topic I want to address is what happens for anyone who's ever been divorced. So if you are divorced or have been divorced in the past, but your marriage lasted 10 consecutive years or longer, you can qualify for a benefit off of that ex. Now, to receive a spousal benefit off of the ex-spouse's record, even if they've remarried or whatever they're doing, you can do so as long as you're unmarried yourself, you as well as your former spouse are 62 and older, and your ex-spouse is entitled to Social Security benefits, so they paid the 40 quarters in. Now, what's different for our divorcees is, with our married couples, you need that spouse to turn their benefit on in order for you to receive it. For divorcees, it's not the case. Your spouse doesn't need to be claiming their benefit as long as they're 62 and older, if you go to the Social Security Administration with your former spouse's name, their Social Security number, a copy of the marriage license, and the divorce decree, they're going to check to see if you qualify for a benefit off of them. And if you can't think for the life of you what your ex's Social Security number was, it is on both of those two documents. So if you have those, you're in good shape. Now, again, if both divorced spouses worked, you'll get the higher of your own benefit or the spousal from your ex. And if your former spouse has passed away, for better or for worse, you are entitled to a survivor benefit off of them. Now, to qualify for that, you need to be age 60 or older. You're either unmarried currently, or if you did remarry, you did so after the age of 60. So for our divorcees, I want to touch on that last point about if you decide to remarry, what happens, because there's a couple different variables involved here. And as a general rule of thumb, once you remarry, you are going to forfeit benefits from your former spouse. But there's some exceptions, right? As I said, if you remarry after age 60, what happens is you can hold on to that survivor benefit from the first spouse or the first marriage, even if you have remarried to a new or a current spouse. What the administration will do is they'll pay you the highest benefit that you're entitled to. So your own, the spousal or survivor benefit from that current spouse or that second marriage, or the survivor benefit from our ex or the first marriage. So I always like to throw this out there. If you're 58 and you're thinking about maybe getting remarried, and that soon to be new spouse makes less than the first, maybe you celebrate your love, throw a big party, but wait till 60 to go down to City Hall to make it official so you can hang on to that. Now, the other exception, as I was talking about earlier, where we're looking on the right-hand side now, is if the second marriage does end. Excuse me, this is at the bottom. And that second marriage ends. So another divorce, an annulment, death, you actually become re-entitled to benefits from the first marriage again. So that's a couple of the big things to be aware of for our divorcee benefits. I do want to save some time and close this out here with, let's say, most people's favorite topic, as I said earlier, the role of taxes and our retirement plan. So regardless of your age, once you start taking Social Security, your benefits are going to be taxable if your income exceeds $25,000 if you're single, or if they're over $32,000 and you're married filing jointly. Now, the good thing is that Social Security benefits are never going to be 100% taxable. The administration does provide that 15% cushion for what's owed to Uncle Sam, but it's frustrating, right? You spend your whole life paying into this program, and guess what? Now it's being taxed on the way out. I do have some good news for you, though. The Social Security Administration, the IRS, they use something called combined income, or it used to be known as provisional income, to determine what your new taxable portion of Social Security will be. Or in other words, how much of my benefits are going to be added onto my income and be taxable in this year. What combined income is adjusted gross income plus tax-exempt interest. So think about maybe like muni bonds, and then half of your Social Security benefit. Now, one thing to be aware of is that there are a number of items that are not included in this combined income calculation. And I did want to share a couple of the more popular ones that we tend to see. Roth IRAs, 401ks, qualified charitable distributions, an HSA withdrawal for a qualified expense. Those are a couple of the big ones that we see that are excluded from that combined income calculation. And I think one of the big, parts or a big avenue that you can leverage, or I want to highlight, is that Roth feature. If you have a Roth IRA, I think it gives you that ability to change the discussion of, should I take from Roth IRA or my traditional IRA first, to what is the right amount I can withdraw from my Roth IRA in order to minimize my taxes in retirement. Now, if you're somebody that is still working and you have access to a Roth 401k or Roth 403b, maybe want to consider increasing the portion of those contributions, because that Roth feature will give you a little bit more flexibility to control taxes throughout retirement. And if you are interested in doing a Roth conversion, please consider not just the effect it could have from a tax side of things, but also with Medicare premiums, because Medicare premiums are based on your income from 2 years prior. So if you do make that change, you might not see it immediately, but further down the line, you see your check and you're like, what happened? It's because it's looking at that income from 2 years ago. So these are the type of topics that I definitely encourage you to talk with both, Craig or the entire ICG Next team, as well as any tax professionals, because I myself am not a tax advisor, nor am I a CPA. So, this is right in the ICG team's wheelhouse. So the point I really want to make is that you can leverage your advisor to find different income streams, whether that's a Roth IRA or something else, to generate income that's not going to be part of that combined income calculation. Okay. So let's bring us home here. The question I always get at these workshops is, John, there's a lot in here. When do I take Social Security? And if you can't see, it's very difficult for me to answer that because every single one of you is different. But what's important to understand is what happens if I claim Social Security before full retirement age or after full retirement age, and the impact that could have for yourself and your family. But, these claiming strategies are very complex and there's a lot to consider. So I think you can boil it into these 3 bullet points that you see on the left-hand side of the slide. Okay, so number 1, are you working? And how long do you plan to continue to work? Because if we are working and we're under full retirement age, that earnings test comes into effect and you could see withholding on those Social Security benefits. Number 2, what is your withdrawal rate, right? How are we going to come up with this comprehensive financial plan to replace or to solidify that other 60% of our retirement income picture? Great topics that you should be chatting with your advisor on to help determine what's best for you. And the third one, life expectancy. If you're somebody who's single, I do strongly encourage you to consider this, because if you're somebody who has a long life expectancy and you're in really good health, it's likely best to let Social Security maximize until age 70. But on the other side of that, if you're not in great health and longevity doesn't run well in the family, maybe it is better to claim that benefit at an earlier age, right? Who am I to say don't take that? Now, for our married couples, the life expectancy question is not a huge concern for us because there's a 50% chance that one of the 2 spouses will live until age 90. So as a general rule, if you're that lower earner, take whenever you want, right? You'll have options to receive that greater amount from your spouse in the future, whether that's the excess spousal or a survivor benefit. However, as the higher earner, strongly encourage you to try to maximize that benefit, because it's not just going to help yourself get some more income, but ultimately it's going to maximize that money for your spouse once you pass away and allow you to potentially lower their tax burden as well. So hopefully those answers can guide you guys to make the best decision for your individual situation. And if you have questions, reach out to your advisor, right? The entire ICG Next team is well equipped to help you put this plan together. I know they have some great software at their fingertips as well. And if there's questions that they maybe don't have the answer to on the Social Security front, you're more than welcome to reach back out to me and we can address some of those as well. So with that, I want to say thank you.